Hey, what's up guys, John here. It was just 6 months ago that Silicon Valley Bank collapsed. First Republic Bank collapsed. You had Signature Bank go down as well. You had PacWest getting acquired by Bank of California. You had all these problems with Credit Suisse. You had all these issues that are happening. And now, just over the weekend, you had Greg Beckett, a top executive at Wells Fargo, jump from the 14th floor of their office tower to his death. And he did so, and his role was internal controls aimed at safeguarding the bank from risk, but his workload apparently was increasing, leading to longer hours and increased stress. But his family disagrees. His family says no, he was actually happy, he was healthy, he loved, he loved going to football games and having time with his family and doing all these different things and activities, and he was never happier. But he apparently jumped to his death. What's happening inside the banking sector is something that everybody needs to pay very, very close attention to, because I think we're going to be walking into a scenario over the next few months that are going to be extremely challenging for consumers, to say the least. And I'm going to break it down for you, show you exactly what's going to happen with credit cards, with loans, with everything. I'm going to show you exactly what's going on. Hit the like button. YouTube will share this content, educate more people about what's really going on in the economy. And if you want to fix your credit, you want to position yourself for the greatest wealth trends of all time, we'd love to help you at my company, GreatCreditFast.com. If you have any issues at all, maybe you have a late payment or charge-off, medical bill, collection, foreclosure, you have something going on in your report, maybe you're ignoring it because you just don't want to face it, it's just more comfortable to ignore it. Don't let those situations get in the way of you getting access to money to be able to invest in real estate or buy a work truck or buy a car or get a personal loan. When things start to get more challenging, only the people with great credit get funding and financing. Look at 2008, 2009, 2010. That's exactly what happened. And banks are already starting to tighten up. So if you have big goals for 2024 and 2025, book a free call below. We'll tell you exactly what it would take to fix your credit, how long it would likely take, answer any questions you may have. Then with all the information, you can make a decision on what makes the most sense for you. Go to GreatCreditFast.com, click the link below. Take a look at this. So right now, banks are sitting on $3.3 trillion in cash amid fears of an economic slump. $3.3 trillion in cash. Since the dramatic banking turmoil that saw both Silicon Valley Bank and Signature collapse in March, America's biggest lenders have become considerably more cautious when extending loans. I've been talking about this, saying this is what's going to happen. They're going to become very cautious on people that offer high risk, bad credit, and average credit scores. An average credit score in America is a 698. U.S. banks are now holding back almost $3.3 trillion in cash amid fears of an economic slowdown, ongoing deposit withdrawals, and stricter liquidity rules. The cash pile is slightly lower than the $3.49 trillion peak seen in the immediate aftermath of Silicon Valley Bank collapse, though still well above pre-pandemic averages. March's banking crisis spooked lenders and saw a significant cutback in credit issuance, which has not yet been recovered as banks prefer to hold cash as insurance against potential U.S. economic downturn later this year. Well, today's a very, very big day. It's October 1st. And October 1st, student loans become due for 44 million borrowers, meaning banks are going to have even less cash to hold as borrowers start to take money out of their savings and they start to pull money out of different accounts to pay off these balances. As that's happening, interest rates are remaining much higher for longer, and Jerome Powell's discussing one more hike this year, which is very bad for consumers and very bad for banks. And that means consumers are going to have higher interest rates on their credit cards, they're going to have higher interest rates, and it's just going to be more expensive to service debt. And a lot of the assets the bank were holding, at 1, 2, 3% interest rates, they're performing very, very well. At today's interest rates, not so much. So these banks are walking into very, very big problems. So you're seeing other hedge funds and executives and people in the banking sector committing suicide, like this gentleman right here. He is a multi-billionaire, $2.2 billion net worth, passed away, a hedge fund magnate. I mean, the guy he has an extreme track record, 1980, 1990, making an absolute fortune with leverage buyouts. This whistleblower blew the whistle on a politician, a very famous politician, and he was going to write a book on this politician at Deutsche Bank, and apparently it was over for him in a park in Los Angeles. And this happened about a year or so ago. So you're starting to see more and more and more of these scenarios where top executives are checking out, to say the least. But look at this. So Bank of America huge bond losses likely widened in the third quarter. Bank of America's big bond losses likely widened in the the current quarter due to a sharp increase in interest rates. Bank of America sitting on $105.8 billion in losses on a $614 billion portfolio. $105 billion in losses on a $600 billion portfolio. Those losses are only going to grow. Fed losses breach $100 billion as interest rate costs rise. The U.S. Central Bank is continuing to pay out more in interest costs than it takes in from interest it earns on bonds it owes and from the services it provides to the financial sector. While there's considerable uncertainty around the corner as it plays out, some observers believe the Fed losses, which began a year ago, could eventually as much as double before abating. Of course, this is going to start getting so interesting, but I think the biggest sector at risk is going to be regionals. Regional banks are going to be the biggest hit because they are the ones that fund small businesses primarily. They're the ones that are funding commercial real estate. They're the ones funding a lot of these, riskier products that a lot of these larger commercial banks don't touch as much. So, for example, regional banks facing credit losses. Moody's sees material exposure to higher risk office and construction loans. A survey on commercial real estate exposure by U.S. regional banks reveals increasing asset risk and potential credit losses as much as loans mature over the next 18 months. With U.S. banks providing more than half of U.S. commercial real estate debt financing, a survey of 55 banks by Moody's shows that lenders have faced higher interest rates and structural shift in demand as more people remain working from home after the 19 scenario. So this situation, we have a couple of things that are very interesting here. You have $2 trillion in corporate debt that has to get refinanced. So all these corporations that borrowed really cheap money are going to have to refinance at these much higher rates. So what are they going to do? They're either going to close down, they're going to issue layoffs, or they are going to start to reduce their office square footage. All of which is not great for the commercial real estate sector held by banks. Right? Banks are holding a lot of the debt from the commercial real estate sector. This has stressed the debt servicing capacity of sponsors as commercial real estate valuations decline. Moody's analyst Stephen Lynch said in a research note, at the same time, strained banking conditions have caused many banks to tighten underwriting, limit commercial real estate, and lending activity. I've been mentioning this is going to be coming. Banks are grappling with material commercial real estate maturities through 2024 that are about to equal 46% of the adjusted tangible common equity estimates by Moody's. Tangible common equity is used to measure the bank's ability to absorb losses. Moody's survey of banks showed that higher risk office loans accounted for 26% of tangible common equity, while construction loans accounted for 30%. These two loans are the most likely to drive credit losses. So this is going to be an absolute bloodbath for small business loans, for commercial office. This is going to be a really, really interesting scenario. And at the same time, this article just came out about 3 weeks ago, September 8th. They said, is this breaking down? Credit card loan defaults hit a 10-year high. Americans are falling behind on credit cards and card loan payments as rates not seen since the GFC, the Great Financial Recession, the crisis, and inflated prices along with rising interest rates suggest it could get worse. It suggests? How would it not? That's the real question. How would it not? You have consumer savings rate hitting a record low. So consumers have less money than ever. The cost of the world is more expensive than ever. You could buy a car in 2008 during the Great Financial Crisis for $7,900. That was the average used car price. Now the average used car price is over $40,000. So you're looking at it from the perspective of if the average car payment right now is $720 a month, in 12 months, about 12 months, 11, 12 months, you could basically buy a used car outright, right? So if the average car term is 60 months, you could buy 4 cars, 5 cars outright for the price of which you would buy a car today, back in 2008. So as this is all happening, you're seeing oil prices rise. Everything is going through the roof. This is going to present a scenario in which the middle class is going to be forced, in many cases, to sell off hard real assets. And this is why, if you look at MetLife Insurance and CNBC and all these large players, what are they all saying? They're saying that large institutional investors are going to acquire more and more market share in the coming years of single-family homes. They're saying that they're going to own 40% of all single-family homes in America in the next 6 years. in the next 6 years. So to say that we're going to have a soft landing, how does a soft landing get them to increasing their position in single-family homes 800% in 6 years? It doesn't. We're going to see an abrupt halt of lending for many borrowers. We're going to start to see a lot of very interesting scenarios, and we're going to see interest rates being a lot higher, I think, for a lot longer. In 2024, many people are banking on a pivot. It doesn't seem like that's going to happen. It doesn't seem like a pivot's going to be happening anytime soon. What do you think of this scenario? Let's have a conversation about it in the comment section below. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, we'd love to give you a free strategy session, tell you what it would take to fix your credit, answer any questions that you may have, and give you the answers to the questions that you're looking for. Go to GreatCreditFast.com. You can click the link below in the description, and I'll catch you guys in the next video.